Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Kate Campbell, welcome to this episode of the Australian Finance Podcast.
Good to be back, Owen, to talk about one of your favourite topics.
Yes, this is not a special episode, Kate.
No, just a standard.
Just a standard episode of the Australian Finance Podcast where we talk about small cap investing as part of our Shares Month 2022. So if you're new here, this is Shares Month. You can go back and listen to all episodes in this mini-series where we talk about everything from getting started in shares right through to Q&A with real-life analysts. In this episode, we're talking about smaller companies, aka small caps.
How small is a small cap?
Well, that depends on who you ask and which market you're investing in. So, for example, in Australia, we might say a small cap company is a company where the total value is less than, say, $300 million. That might sound like a lot of money, but it's really not. So a large cap company, if we take the other end of the spectrum, a large cap company might be, say, Apple in the United States, which is trillions of dollars. Or here in Australia, you might have Telstra, which is in the billions of dollars, or Commonwealth Bank, which is over $100 billion. Now, some people might add a further kind of like, I guess, line in the sand here. They might say a small cap is below 300 million. A large cap is, say, up to 50 billion. And then anything over that is like a mega cap. But
it's a really large range.
There's many ranges. Then you can go mid cap if you really want to. But if you ask someone in Australia what a small cap is, they might say something below 300 million. If you ask someone in the United States what a small cap is, they might say companies below $1 billion. So you can see how the kind of goalposts shift. That's because the companies over there tend to be bigger.
Yeah, because we talked about blue chips as in large cap stocks the other day on our jargon episode.
Yes, that's it. So in that episode, we talked about a few things you should be aware of. The first is we talked about market cap, and that was basically the total value of all shares in a company. So if you added up all the shares and the price of those shares, all of those, the value of that, that's market cap. And we also talked about blue chip. And we said that blue chip shares were big companies with like big brands and, if not globally diverse operations, maybe nationally. So you could go from Melbourne to Perth, from Perth to Cairns, and you'd still see the same brands if you walk down the street or you talk to someone, they would know what you're talking about. So we're at the opposite of the spectrum for this episode.
Yeah. And are small caps characterized by anything else apart from the market cap?
Well, there are many different things that you should keep in mind. The first and most obvious one is the risk, because small cap companies tend to have like single business models. They're not always, but for example, let's say Commonwealth Bank. Commonwealth Bank is a blue chip company, so it's known not only in Australia but globally. It has a huge share of mortgages. It's got a huge share of bank accounts, term deposits, online banking, brokerage through CommSec. It used to have a huge operation in insurance and in like wealth management. It doesn't have those two anymore. But you can get the sense that if one of those things failed, they still had all the others. Whereas with small cap companies, you tend to have like one business line. So they might do just banking or just financial advice or something like that. The way that translates for investors is that the smaller companies tend to bounce around a lot more. So you get a lot more varying outcomes. So one day small cap share might be up 5% or down 10%, but that's normal. Whereas you wouldn't see that with CBA.
Yeah. And given that small caps are by definition smaller than things like CBA and potentially riskier and more volatile, why do you even bother with them?
Yeah, it's a good question. So when I was a professional investment analyst, like I was working to research investors that invested in various asset classes. So let me just unwind that jargon a bit.
Yeah.
So my job was effectively to go to other experts and pass judgment on them. So if they were good at their job, I would say this person's recommended. If they maybe said one or two things or they didn't really have a good investment process, I'd say we don't think that this investor is good enough. So we're not going to put a recommended rating on them. So my job was effectively to judge people who judged investments. It's a bit of a weird thing. But what we could do is once we've done a few hundred of these interviews and a few hundred of these reviews of other investors, what we found was that the investors who focus on small companies, not just here in Australia, but globally, tended to have better outcomes, not always. It's not a hard and fast rule. And there are a few reasons for that. So some people might just think because small, they can grow. Not necessarily. Like a lot of companies, that doesn't happen. But small companies tend to be what we call less followed by analysts. So if, for example, you have Commonwealth Bank of Australia, I don't actually have it up in front of me right now, but with Commonwealth Bank, I checked not too long ago, and I think it had something like 36 professional analysts following CBA's every move. So that would be like, what's the CEO's latest commentary? Is an analyst at the Reserve Bank meeting to judge what's happening with interest rates? Is that, so on and so forth. They're analyzing it from every direction, every moment of the day. Whereas there have been numerous instances where I've come across small companies that have no analysts providing research on them. So what happens there is this would just be like you go down to like a cafe down the street and you just have the whole street at your disposal. You can look at every business in that street and no one else is looking at them. No one else is researching those businesses. So that gives you an opportunity to be like, oh, well, that one's doing really well and this one's doing really well. And you discover it before other people do. So this is what sometimes we'd call this an informational edge. We'd call it an analytical edge if you can analyze a business. And there are many other, I guess, smaller quirks of these smaller cap companies that lend themselves to being under-researched, which means you oftentimes find that the valuations aren't as rich as larger cap companies.
Yeah, because it's quite challenging probably to find information on some of these companies, especially if they're quite small, they don't have that many employees. There's only so much you can find on Google. Yeah,
well, that's a good point you bring up about employees. One thing that we look for, which we went through in our checklist, is we talk about there's like a 5-point checklist that we have. And one of those things is management, right? If you're the CEO of, I don't know, let's say a company like Apple, you're Tim Cook, you might have 100,000 employees. So you've either got to have a fantastic culture and like management layer in your business, or you're not going to be effective. Now, if you take a small cap company, they might have 30 employees. They might have 50, they might have 15, depending on how big the company is. And what ends up happening is that in those smaller businesses, if you have really good management teams, they can do fantastic things. Now, they can also do the opposite. They can take advantage of you and they can take advantage of their employees, but they can have more sway in the business. So that's another thing to keep in mind. And you mentioned the number of companies. When we talk about the ASX 200, that was that index that we talked about in the Jargon Buster episode. So those are the 200 largest companies, and that's where Commonwealth Bank would be. But outside of that, there are over 1,500 companies, right?
Quite a few.
Yeah, there are. Yeah.
And that's just in Australia.
That's just in Australia. There's tens of thousands, over 150,000 around the world. And those are just companies that are on the stock market. Here in Australia, we have over 50,000 individual companies, that make over $2 million of revenue. So this is not just like these things are everywhere. Australia is a small business economy. So if you didn't look at small companies, you'd probably lose a lot of the opportunity set.
Yeah. And how do you, given the risks involved with small caps, how do you even sort of assess how much to include in your portfolio? Is your whole portfolio made up of small caps or?
No, it's not so much anymore. If I was a private investor, so what I mean by that is if my only care and consideration was my own money, I would probably invest, most of it in small companies. You've got to remember too, this is coming from a person who is a professional investor and also has a small business. So I'm used to the risk. I've basically gambled all of my personal net worth on a single company, right? Yeah. That's what a founder does.
Yeah.
So for me, my risk tolerance is extremely high and I've got the knowledge of investing.
Yeah. And I guess that's why we put the small cap episode last in shares month, because it's not something you jump into straight away. We usually recommend starting up with ETFs or something a little bit less scary to start with. Yeah, because I've got small caps in my portfolio that might be down 50% and then they go up 200% and then they go back down another 100%.
Yeah.
And this could all happen in the space of a month. And so it takes a lot of sort of conviction to stick with a company when you're seeing these wild swings. One, you want to sell when it goes up 200%, and two, you also want to sell when it goes down to, well, not 200%, but 100%.
Yeah. And this is the thing, Kate. You're right. You've been actually investing for a lot longer than I would say most of our listeners. We do a survey of our listeners, and some of them have been investing for quite a while. But I wouldn't. The thing is, when most people invest in small cap companies, they do it for one reason and one reason only, and that is greed. They find some speculative miner in Africa that digs something out of the ground, or at least it wants to, but hasn't done it yet. Or they go, oh, this new technology solves this type of disease and it's the only company in the world that can do it, trust me. And it doesn't work out. But the reality is, if you think about it, most of the companies that are on the stock exchange that we say are small cap, under $300 million, they still have 50 or 100 employees. So if you were to go down the street and you were to see a company with 50 or 100 employees, you wouldn't say that's small. You'd say, oh, I work for a pretty big company.
Yeah.
Right? Yet on the stock market, for some reason, we think that's small, right? And this is what I just kind of want to get out there, is that even though share prices of small companies are riskier, they bounce up and down like pretty wild, they actually are, most of the time, pretty meaningful sized businesses. And so therefore, you can still run the same checklist that we use on the big companies and the little companies. You just need to be mindful that there will be, like, the quality spectrum is different. Like, you'll have a lot of really good companies, a lot of really bad companies. And I bring this up because even though we say small cap shares are risky, it does not mean that all of them are risky or that all of them are bad businesses. Like, for example, in our business, Kate, we have less than 10 employees. Is our business bad or risky compared to one that has 200? Maybe, but maybe not. You know, we might have a really high quality small business, but it doesn't, and even though we're smaller, doesn't mean that we're riskier. It just means that we're smaller. And so I think that's an important part too. But for when we talk to investors, like, if you're going to talk to someone, if you're listening to this and you're thinking, I'm going to talk to someone about small cap investing, the first thing they're going to say is it's risky. And you can say, yeah, probably, you know, you get a lot of ups and downs, but at the same time, you know, they still are companies and you can still do your research and find out if they're good companies or not.
Yeah. I think it's quite interesting. A lot of those barbecue stock tips you get, the things you read about on forums or Facebook groups, they often fall into that small cap category. Like, people aren't going, hey, mate, did you hear about CBA? Like, it's got this great thing launching next week, get on it. They're talking about something that's really small and speculative, like the mining or biotechnology. And there are so many companies out there, as you mentioned. Like, how do you even filter that down? If you just say, I'm interested in investing in small caps and I want to learn more about this world, and you're looking at, oh, there's like 1,500 companies I could choose from. Like, how do you narrow that down into something usable? Because there's a lot of companies that aren't investable, as we'd say.
Yeah, I think I didn't answer your question properly before, but basically, if you're starting and you're thinking about small cap investing, I think you should try to get to, say, 10 or 20 different companies, and you should start really small. So as small as possible, basically, because you should want to get to know the company by owning it, and then it kind of gives you a buy-in, so then you research it more. But to your point, so you want to get to 10 or 20, and you might want to put, like, you know, less than 1% in each to start with, right? Of your total portfolio. Well, okay, how do we get from, say, 1,500 companies just in Australia down to that list? Well, we followed the process that we did before, in that we start with that massive amount, and then we're looking for companies that fit our 5-part checklist. So for me, the easiest way to get rid of many companies is to know that I'm probably not going to invest in biotechnology, and I'm probably not going to invest in resources companies. That's not a knock on those two industries per se. It's just more to say that those are not within my circle of competence. If we remember that conversation where we talked about investing in shares of companies that you know well, those companies I do not know well. And I could, if I spent years studying, you know, engineering, or maybe if I was studying geology or biotechnology, and maybe I could understand them. But for the most part, it's just not worth my time. So I kind of exclude them. And actually, it's actually funny. Once you exclude the resources companies and the biotech, the numbers go down to hundreds, not thousands. So that's the first thing. And then the other thing that I would do is, this is a really good shortcut for people, is follow other investors who you respect. And when I say this, I don't mean like Hot Copper, I don't mean Facebook, I don't mean Reddit, I mean actual investors. And the way you can do that is you can find the fund managers that specialize in small companies. So if you want to find some of them, you can go to like Livewire. You can just look around at our podcast, see who we've interviewed. You can jump on Twitter, whatever.
Because they disclose usually their top 5 or top 10
Yeah,
positions quite
typically
publicly.
disclose their top 10. So I'll give you the names of some. There's a guy called Tony Hansen from Sydney. He runs EGP Capital. I think Joel Fleming is still at UBS. That's the investment bank, but at UBS Microcap Fund, if you Google that. And there are heaps. I mean, if you're interested, just let us know in the group, the Rask Facebook group, and we'll give you a list.
Try and put a list together, yeah.
Yeah, because there's heaps. And what you can do then is every month when or Lakehouse Small Companies Fund, Maven, although they don't really issue reports, you can follow what those investors are doing every month, like what they're disclosing. And sometimes they'll have like a paragraph about why I bought this or why we invested in that, why we sold this. And it's not so much about what they're buying and selling. It's actually just learning about the companies that they are buying, because then you can get a sense of, okay, what's available in the market. 2 more that I'll throw out is DMX Asset Management, and the other one is Merriweather Capital, which is Luke Winchester. So you basically take that list of 1,500 and you know from the outset that you're not going to invest in certain sectors. And then you basically find other investors who, it's called follow the leader, by the way.
Yeah.
You follow the investors who are reputable, and you follow them. And you don't necessarily, this is the important part, do not necessarily go and buy everything that they're saying. Do not do that. That's a pretty poor strategy. Instead, just use their ideas to put them on your watch list and then run them through your own checklist. And that's probably the easiest way to do it.
Yeah, it's quite interesting how you see similar companies popping up in different fund managers' portfolios.
Yeah, so that's what you could do. That's a good point, Kate. So you could have, say, if you just listened, if you got, say, 3 or 4 fund managers which you'd like to read and you follow their reports every month, you might see that this one holds XYZ, this one holds XYZ, and this one also holds XYZ. And then you're like, okay, well, maybe I should take a look at that company that they're recommending or that they own. And I've done that with a bunch of companies, and it's produced really good results. But I didn't just buy them blindly. I obviously went and did my own research. But that's a good shortcut, because it's almost like you have a team telling you.
You get to piggyback off.
Yeah. It's like you have a team in front of you saying, we just invested in this. And they're like sending you a message and you're like, okay, great. But it's like they're working for you if you think about it like that. So that's how we do it.
Yeah, because I know you've mentioned in the past, you don't get bonus points just for being the first person in the country to come across this particular smaller company. Like if you get the idea from someone else, like you can go and do your own research, but you don't have to be the person who discovers it to do well out of it. That's
the quote is, there are no points for originality. So, this is particularly the case in smaller companies, because here, if you have the attitude of, I need to discover this for myself, you're going to miss so many opportunities, because there are over 1,500. There's no way you could spend 2 or 3 weeks reading about this company after work or before work or whatever, and getting comfortable with it. By the way, you don't have to spend that long, but you just couldn't. It would take you an eternity. Like Warren Buffett and Charlie Munger used to say that they would give people advice, start at A and go through to Z. That'd be impossible, because there's like 10,000 companies in the United States. So instead, what I'd say is use this as a short list, and then don't feel like you have to be the one that comes up with the idea. You can just own it and be like, yeah, I got this idea from someone else, but then I researched it myself or whatever.
Yeah. You don't have to give credit really even.
Yeah, that's it. You don't have to.
And so once you've filtered down the list, so you're down to maybe a couple of hundred because you've cut companies out that aren't in your circle of competence, what are some red flags of other like small companies that you would avoid?
Yeah, so avoiding is probably easier than like finding things. So people are finding positive things. So what I mean by that is, when you've got a big like data set of anything, basically, you want to exclude, because excluding is quicker. So what I mean by that is, let's say you got a list of 200 companies. Now, in your strategy, you don't want companies with lots of debt. So the first thing you could do is you could use a tool, like a free or premium tool, like the tools in your brokerage account, or you could use something like Ticker, TIKR, which is a software that we use, or you could use simply Wall Street. And basically what you could do is you could use those to be like, I don't want to invest in companies with lots of debt. So you could look up the company that you're researching. If it's got lots of debt, it's out.
Yeah.
Move on to the next one. And so you get down to this more manageable list of companies. Then you might say, okay, I'm going to do a little bit of reading. The first thing I'm going to do is I'm going to quickly Google company name, management team. And then I'm going to go to their website and look at their management team. And if I realize they don't have a founder or they don't have, someone that's been there for a long time, I'm going to avoid them for now. And that's because you're trying to focus on people that have been in the game for a while, that have experience, etc. The other thing that I would probably do straight away is just make sure the company is actually making money. So one of the big pitfalls, and this is the risk that we have running this episode on the Australian Finance Podcast, is that a lot of people hear us talk about small cap companies and they just go for the most exciting one. And typically that's the one which has promotional management teams, like management teams that will just feed you anything and like anything you want to hear. And yet they haven't got a dime of revenue or cash flow. They haven't made a cent. They've just got this big promise that, it's going to be the revolutionary technology or whatever. So what I would say is look for the companies that are already making money. So it's either profits, revenue, or cash flow, because that will help you weed out all like the people that just want to suck you in.
Yeah, it can be a bit of a warning sign when a company's spending more time advertising to investors than to its actual customer base.
Yeah, that's it. Yeah. And, we're about to get to this, but it's basically like, well then, okay, how do you start that research process? One of the beautiful things about smaller companies is typically they are small. They might have like a warehouse. They might have a single warehouse as opposed to thousands. They might have one office building or headquarters instead of like one in every major city.
Yeah.
They might also have, employees that are just like, you can just go and talk to them. They might have only like 5 stores as opposed to 5,000 stores. So imagine instead of looking at Starbucks, you might get some sort of indie coffee brand that's on the ASX that you can invest in. And so what that means is you can then go and talk to people. You can go and try the products. And you know that the service that you're getting is kind of more indicative of the business as a whole. So you can go out and you can actually experience the products and services for yourself. But before I would commit that time and effort, probably what I would do is just read the first annual report that comes up when you go to the investors section of their website. Just read the first annual report. And I don't mean the whole thing. I just mean the chairman's letter and the CEO or managing director's letter, which are both at the front. And they're typically only 5 to 10 pages. And it's actually really interesting because they talk you through the business and what they've done that year. And so that's what I do there. The other thing is that you can use like all of your internet search skills. I remember when I applied for this job, Kate, this job quite a few years ago, it was like a really good job at a really high profile company. And one of the key criteria was good internet search skills. And I was like, that's me. I can do that. I've been using Google for years. But it's actually a really important skill for investors. You can actually just use Google to find out what the company does, what products they sell, what people are saying on forums, and just get to know the business. And that's basically how you do it. And just one final point here is that if there are no analysts out there that are currently publishing their research, it might take you a little bit longer to learn about the business, but that's good because, I've got a note here that if it was easy, everyone would do it.
Yeah, because some of these smaller companies, they haven't had any press coverage before. There might not even be many customer reviews online. It might be quite a lot harder to find any information. Yeah.
So normally like when you say if you're researching Apple as the company, you could go to like the Apple website, you could talk to your friends, you could do whatever.
1,000 different analysts blogging about
it. Get in the shop and just see what products they sell. Yeah, and there'll be bloggers, there'll be Twitter people, there'll be Reddit, whatever. But with smaller companies, you might be lucky to find like one person who's posted about it. And so one thing that you can do is if, say, for example, you're researching a company that you're not really familiar with in terms of its industry, you might say to a friend or a family member who you know that works in that industry, they might not work for the company or whatever, have you heard of this business before? The really good example would have been Afterpay in the early days. You might not have used Buy Now, Pay Later, but you might have known someone that does. And they might have been like, oh yeah, like I've used this before. It's actually really neat. I keep using it now. That's a really strong sign that Afterpay was a good product, not only for the business, but for people in the industry, like for retailers. I remember when I spoke to someone who was, who had I don't know if you call it like a casual clothing line in Adelaide, but they had this store and it was quite trendy. They'd do like online or in-store sales. And Afterpay was rolling out and they realized that they could do both online and in store, and they're like, oh, well, I'm going to start using this because people are asking for it. And so the feedback loop was like really positive there. And all I would have had to have done is just talk to that woman, and she would have said, yeah, it's really good. I'm going to keep using it, even if it costs us money or whatever. So, you know, there are many different ways you can go and get that research. I would say YouTube is a great first base as well, but don't be fooled, because a lot of YouTubers, a lot of content creators have tried to hack YouTube's SEO, and they put like company name, stock review, and then you're like, yeah, but you don't actually know anything about the company. So I'd be more looking for like product videos.
Yeah.
So like explain the product. Like we make widgets for aircrafts, and this is how we do it. And there's like some sort of lost archive video with someone, and it's interesting. It tells you a little bit about it, because you have to be like Sherlock Holmes, basically.
Yeah. And one of the other interesting things that sort of I noticed with small caps is sometimes if as you mentioned, no analysts are covering them, the media aren't really interested in the story yet, there's not much hype, like they can just, for many years, maybe even a decade, they can just coast along. Like they don't go up, they don't go down, they just kind of go sideways for a long time because for the share price to go up, someone else has to be prepared to pay more than the next person. And so if no one knows about it and no one's really interested in it and the story's not really sexy, as you'd say, at the moment, you might hold on to it for a long time and nothing happens. And like, how early is too early to get involved? Like the company might be great, but if no one cares for a decade.
Yeah, so when I started investing, there was this really weird theory about if a company starts paying a dividend, it's about to go up in value. That's totally not true. So I got suckered into that one. The other one was, once a business starts earning X dollars of revenue, it's going to go up. Neither of those things true. Like there's no hard and fast rule. So what I'm about to say is like you could use all of these in tandem. Don't necessarily just say that there's one rule that their share price will go up after this happens. But yeah, if a company starts paying a dividend and it's a sustainable dividend, like it's done it for a few halves or years, that's normally a good sign that the business is, it's operating and it's reaching a point where it's like more mature, because typically more mature businesses do that. Otherwise, they just keep the money for themselves and reinvest
different
it.
people start paying attention when a company pays a dividend. It gets the retirees a bit more excited.
Yeah, and it gets people that are focused on income really excited, because that's like the company's profits coming back to shareholders, which is really attractive. The other one is if a company is reaching profitability. So it doesn't have to be at profitability yet, but if it's reaching profitability, so you see when you go into the income statement, which is available in the annual report, you'll see a bit down the bottom that says profit attributable to shareholders. That's the line that I'm talking about. And if that's starting to go positive, that's normally a good sign that the business is starting to reach what we call it's starting to get operating leverage, which means that its operations are starting to grow. So it's earning more revenue, but its costs aren't going up. So this would be like, it takes 2 years for a cafe to start making a profit. In the first 2 years, it's using money and its revenue hasn't gone up as high because customers haven't heard about it. It hasn't got that loyalty yet. But after a couple of years, you can see that the cafe is starting to get regular customers. More people are coming because they've heard about it. And that's what I'm talking about when it starts to make a profit. There are many ways you can identify these companies, but I'm thinking in the top of my mind, I know a bunch of companies that have made it through our checklist, right? And the companies that make it through our checklist and seem to be really impressive are companies that are making profits, have management teams that are kind of like, not visionaries, but they're just focused on the long term. So they're saying things like, in 2 or 3 years, we're going to reach X number of customers or something like that. Like they've got a plan to get there. The other thing is that you want companies to be generating cash flows. So this is where you go to the cash flow statement in the annual report, and you'll see it there. There's a line at the very top which says cash receipts. And then you can compare that to the next one, which is cash payments to employees and contractors. So that's like what's coming in, what's going out. So you obviously want that to be a positive number over time. And so these are some of the signs that a company is starting to reach a point where it's growing. And altogether, it's I would say that's probably the best way to get an indication of when investors are going to start paying attention. Because if you think about it, if you're looking for those things, chances are everyone else is looking for them too. So if you can try and get to that early, then you can effectively wait for those investors to come along and see, oh, hey, this company is actually growing. Then you can try and preempt that a bit.
Yeah. And I think the other interesting thing with small caps is often sometimes they can't recover from bad news events or a negative report, whereas something like Cochlear, which is a large hearing aid manufacturer in Australia, where if it has a product recall, it can bounce back. But
it did.
some of these small caps, they might have trouble with that. Like, how do you deal with the fact that one thing going wrong could tank the company?
So this is bittersweet, because one side of me says that if a company only has like one product or service, it's much easier to research and analyze, because you can get your head around it. You're like, okay, it does payment terminals, or it does this one type of hearing aid or something. I don't know. Whereas if you've got Woolworths and it's got like all of these different businesses underneath it, and you're like, oh, I don't really understand all of these different ones and how they all come together. You can actually, it's kind of the sweet part is that it actually makes it easier to research, and you know that the management team are focused on their one thing. So just an example of a company here in Australia, which company I own, so full disclosure, it's called Kip McGrath Education. Trades under the ticker symbol KME, and this is not like a recommendation, it's just more of an example. But this little company does tutoring, right? And over the years, and it's done this for decades, like 40 decades, right? And now the son's in charge and the father started it, and so on and so forth. Now, this business has never really done anything other than math and English education. And I asked the CEO about it not so long ago, and he said, yeah, well, it's because we believe that math and education are the two core pillars of learning. Once you understand those two things, you can do anything. And so there's a company that hasn't changed away from that. But, if its strategy was, let's do everything, let's go and do adult education, let's do this education, let's do that, and let's expand here and expand there. And that's where I'd start, like warning bells would start to go off, because once a company goes down that road, it's very hard to come back. But sure, like if their tutoring business fails, then they're out of the game. But this is where it comes back to your question before about, how many positions would you have? How much would you put in each one? You'd only start with a very small amount in each one until each of those businesses have started to prove themselves, and you get to a point where you're confident in them.
Yeah. I guess it's interesting trying to work out how much of your portfolio to allocate to small caps. I almost see my small cap portfolio as like a separate portfolio to the rest. I don't really see it in the same, like I'll have it completely separate to my core ETF portfolio and any large caps I have, just because they're completely different ways of investing, and I'm investing with different time horizons and different risk profiles. So for me, it helps keeping them separate.
Yeah. And I would say that from everyone that's listening to this, I love small cap companies. Like, I can't begin to tell you how much I love these small companies, because I find them really interesting, because they do something. I'm like, oh, that's just like the business that's from down the road. And I think about this, and it's not about investing. I just find it fascinating to learn about them. Like I was talking to a bunch of people at a wedding over the weekend, and they were telling me what they do for a profession. I was like, oh, and one of them was a carpet layer. And I was like, oh, cool. So how much does a carpet layer get paid? Yeah. I was like, oh, nice. Okay, cool. And who makes the carpet? Oh, you got a factory. Oh, cool. Okay. So who owns the factory? And you can start to I'm just curious, to find out how this thing actually works. Like, how do you get someone in a house, to let you come in their house and pay you $4,000 to put in carpet? Like, how does that go from there to here, and who makes money?
The whole value chain and how
the value chain, that's the word. Yeah, the phrase. And I just love that. I find that fascinating. Like, some people aren't like that. I'm just maybe a bit of a nerd, but when you have small companies, you can ask those types of questions, and you can call management. You can call the management team, and typically it's the CEO that will answer. Or if you go into this is a little hack for people that are listening and want to go down this path. You can go on the ASX announcements that they have, and at the bottom of the thing it will say this media release was published by, and it'll have normally the CEO's name.
And their mobile number.
His or her phone number and their email address. Just send them an email, ask them questions like, hey, well, how do you get the carpet from here to there?
Because they're so small, they don't have investor relation teams.
Yeah, they don't have
comms
50
managers
people.
Or brand managers. It's kind of like when you're in primary school and you're all writing letters to your favorite authors. You can actually email these companies and they quite often respond.
Yeah, that's it. And so
you've got a genuine question.
But yeah, absolutely. So I'd say that one of the things to think about is you probably wouldn't want to go down this path until you've done your research and you've built a portfolio outside of small caps. So maybe start with ETFs, then maybe try some blue chip shares. And then, as you said, you can kind of build this kind of, let's just go air quotes, because I don't want to say it's fun money, but I'm going to say fun money, like a portfolio that allows you to scratch that curiosity.
Yeah.
I find particularly with young men, if I say don't invest in small companies, they'll go and invest in small companies because that's what they want to do.
Yeah.
So that's okay, do it, but still have your dollar cost averaging and your core portfolio over to the side there, and start with a little bit of money in these more exciting names.
Yeah. And I know if people are interested in learning more about small caps, you've interviewed a lot of small cap fund managers on the Australian Investors podcast that people can listen to.
Yeah. So we just, as at the time of this recording, we are due for our last episode of our 10-part series on the Investor Bootcamp. Now, as part of the Investor Bootcamp, we talk about small cap companies, and there are some small cap investors in that group.
Yeah.
Where I would also direct people to go is to my friend's website, which is strawman.com. And on that website, it's just a bunch of private investors, so individuals on that website contributing research. And what I love about it is, for small companies in particular, there are heaps of people on there who are like, if you don't live near the factory the company that you're researching is operating from, there might be someone in that community who lives next door that goes and takes a photo of it and be like, hey guys, just reported back. Here's what's going on at the factory today. And it's a really interesting community because you get to learn about these small companies. So they're like, head over to the Australian Investors podcast. We've got links in the show notes to other resources. But yeah, I just want to say it is important that when we talk about small cap companies, it's not like all or nothing. So you can take it slow. It took me quite a number of years to realize that small cap companies are great, but it needs to, like, that type of investing needs to be respected, because it's very easy to get ahead of yourself.
Yeah, you can get very excited and drawn into the hype that the news and the investors around you are bringing up. And I think where people often go wrong is they put 100% of their net worth into one individual small cap company, and that goes wrong time and time again. There'll be one person out of a million that makes a fortune, and everyone else will lose money.
Yeah, like say if 20,000 people listen to this podcast, do not be the one person that goes away and puts all of your money in like one company or all of it in small caps.
I wouldn't even do that with a large cap.
Oh yeah, no,
I would never put all of my money into one single company.
Yeah, I'm a professional investor, and I've held Apple, which is my biggest position. I've held that for many years. I don't think it's over 10%, or it might be just. And that's after many, many years, and it's the biggest company in the world. So that gives you an indication. I've got many small cap companies that are like 0.5% of my portfolio or below. That's not because I've got a lot of money, by the way. It's just because there's tiny little positions. And I think that's the way you can treat it, because as the company grows and as it proves its business, you can just invest more. You can't always invest less. Sometimes you can't get that money back. So, and another good resource is actually Rask Media, our website, raskmedia.com.au. There are some interesting smaller companies that start in there.
Yeah.
And they get coverage there, whereas they might not on other websites.
Yeah, well, we'll include all those resources that we've mentioned and some of those fund managers and the episodes from the Investors podcast in the show notes if people want to learn a little bit more about small caps. Yeah,
for sure. It's a bit of the Wild West. The small cap end of town can be a bit of the Wild West. You've got CEOs that want you so badly to invest in their companies that they're going to almost say anything. You've got other investors who get really they beat their chest and they're like, you cannot say anything bad about my company. How dare you?
Get a bit intense out there.
Yeah, and social media can be very dangerous too. If you're in an environment where someone's like, this is going to go up, this is going to go up, this is going to go up, greed. And they might actually, who knows, work for the company. They might own shares. There's this really weird thing that happens in social media on Reddit and Hot Copper and all these places. People actually refer to the companies that they invest in as we. So they say things like, wait till we get to 50,000, widgets. Wait till we expand into China. And I'm like, what are you talking about we? There's no we. It's just
they have the ticker code for the company that they've invested all their money in their bio.
Yeah.
I see that as a bit of a red flag.
Yeah. So remember that the companies don't owe you anything. And no matter how much you do a song and dance, it doesn't make the company go up. So what I would say is just to keep to your checklist, be prepared to be skeptical and use those kind of traits that I mentioned before. Make sure they're earning money. Make sure they've got low amounts of debt. Make sure their management team have been there for a long time. These things all help you avoid those mines that are in that minefield. So yeah, Kate, it's good fun talking about small caps. Can be risky, but can be exciting too.
Yeah, awesome.
Kate, as always, thanks for joining me.
Thanks for listening, everyone.